Okay, we got record low housing inventory with a new record low interest rate. Is that a recipe disaster? I don't know. We're going to have to see, but I think a lot of you understand where this is going. Welcome to Housing Bubble 2.0 News of the Week, or as I like to call it, another episode of As the Housing Market Turns. I'm Randy Patrick, your host, putting the realism back in real estate. Today is the 19th of November. We're working our way through the month. Information that came out today is based really on the existing home sales report produced by NAR, National Association of Realtors. And again, we hit some record highs. So that's what we're going to talk about today. But first of all, if you're not already a subscriber and would like to receive notification of the new videos that come out, please smash that subscribe button. Help my channel grow. It'd be really appreciated. Thank you very much. And thank you to those who are always continually watching the video and giving me your intel on what's going on in today's local markets across the country. Now, why this is so interesting is because the last video I spoke about, we had a couple of what I would call monumental blurbs in the news here. And what I mean by that is some admissions about, we're in a housing bubble, right? So Robert Shiller was talking housing bubble, basically said, quoted, we're in a housing bubble, simple as that. And Lawrence Young, chief economist for NAR, National Association of Realtors, on record saying prices are rising too fast. So, okay, in the end, guys, this is not that big a deal from what these guys are saying, but for me, I like to have certain things laid out before me, and I think it's important that that there's an acknowledgement as to what's going on in the marketplace. So the two guys that people are looking to, or at least providing information on the housing market, are kind of coming out saying housing bubble or prices rising too fast. All right, so you take what they give you, and these guys don't say too much with the way they double talk and try to we'll say place things in the desired housing narrative. So anyway, having said that, we're going to start off with mortgage rates breaking a record again. This is out in Housing Wire. So guess what? There have been 17 consecutive weeks when an average mortgage rate's been below 3%. So the average U.S. mortgage rate for a 30-year fixed loan fell this week to 2.72%. Freddie Mac said in a report Thursday, which is today, the 19th, okay? The lowest rate in the survey's near 50-year history. Something else, right? This rate broke the previous record set on November 5th by 6 basis points. So this is the lowest rate on record. Again, 17 weeks. While the economic growth remains unstable, strong housing demand continues to have a domino effect on many other segments of the economy. So basically, I guess, weaker consumer spending data, which accounts for the majority of economic growth, forces the rates to go lower to stimulate purchases, I would imagine here. All right. Now, interesting enough here, it basically says here that, these highly favorable mortgage rates are continuing to bring fresh buyers in the marketplace, said National Association of Realtors Chief Lawrence Young. As a result, home prices are increasing too quickly, he said. So there's underline, they are increasing too quickly, far too quickly, which may prove difficult for first-time home buyers trying to come up with a down payment and get into this market. So yes, so as low interest rates perpetuate, the increase of this bubble is just making it more and more difficult and more expensive for buyers to get into the market, particularly the first-time home buyer segment, which really boils down to, getting that low interest rate, not low interest rate, the low down payment, or getting a down payment together. With prices rising and people being priced to the market, they have to go to higher market segments, which makes it difficult for them financially and can cause problems. So now we move on to NAR. Existing home sales jumped 4.3% to 6.85 million home sales in October. So key highlights for NAR, National Association of Realtors, is the home sales grew for the 5th consecutive month in October to a seasonally adjusted 6.85 million rate, up 4.3% from the prior month and up 26.6% from a year ago. The median existing home price is $313,000, almost 16% more than a year ago, than October 2019. And total housing inventory declined from the prior month from 1 year ago to a 1.42 million units available, enough to last roughly 2.5 months, another record low at the current sales price. All right. And more than 7 in 10 homes that sold last month in October, 72% were on the market for less than a month. So what's happening is people list their homes. People are jumping on them, get them under contract, and off they go just because there's a panic and there's a frenzy to keep buying now with low interest rates at record lows. low inventory. I mean, I know there's a lot of games being played out there right now, and a lot of people are feeling that real estate agents are sort of fueling the fire, saying, hey, if you don't buy now, it's going to get worse next month. And you know what? It actually has been getting worse next month. But it just boils down to what you feel comfortable with. Now, a lot of people talk to me and call me and say, listen, what do I do? Well, it boils down to, what's the gamble you're going to face here? Are you going to buy the property now because you got a low interest rate, or could it go up a few more $1,000s? So you actually have to financially work out the numbers to see what's best for you. And again, from the investment side, we can look at things from a different perspective. From the primary home side, there's more than just price and a rate. There's what's needed for your family, how long you're going to be there. If you plan to be there for a couple of years, maybe you don't buy. If it's 10 years plus, well, then guess what? You're going to ride out a couple of real estate cycles. So it just depends on what is good or what's needed for your specific situation. I look at it going, get all the information you can, take advantage of any rates you can, and do the best you can in negotiation with your real estate agent and the homeowner. Do the best you can. Simple as that. Okay, let's move on. What we got going on here is essentially considering the fact that we remain in a, I guess you could say, let me find this here. Considering the fact that we remain in a period of stubbornly high unemployment relative to pre-pandemic levels, and the housing sector has performed remarkably well this year. That's what Lawrence Yun says. While coronavirus-induced shutdowns hindered virtually all markets, Yun says the housing industry has mounted an impressive rebound. I do believe that is the case here. So, I'm not disputing that. It's just the point where it's like, how high is this going to go? So the surge in sales in recent months have offset the losses from the COVID spring losses. And with mortgage rates projected around to hover 3% in 2021, he expects the market's growth to continue in 2021. Yun existing home sales to rise by 10% in 2021. Yeah, but the whole point is, where's this going to go? When we're looking at 2.5 months worth of real estate inventory, it's pretty tough. And to give you an example, I mean 5 to 6% or 5 to 6 months worth of inventory is typically what we would I guess you could say agree to talk about a healthy market. There's enough product in the marketplace that buyers can buy and buyers can buy, sellers can sell, and we're not having to jump through hoops or make rash decisions or stress the market like we are right now. So please keep that in mind. So it's kind of difficult. Regional breakdown. So September saw homes in the Northeast climb 4.7%, a 30.4% increase, and the median price is up 20%. In the Midwest, sales jumped 8.6%, up 28% from a year ago, and the median price was $243,500, a 16.7% increase. Home sales in the South increased 3.2%, up 26.5% from a year ago. The South's median price is $272,500, an almost 16% increase. Existing home sales in the West inched up 1.4%, a 22.8% increase from a year ago. The median sales price was $467,000 plus, up 15% from October 2019. So we can see that all market segments that are in how NAR breaks it down have had increases on sales volume and price point. So this is their kind of, we'll call it, for lack of better words, PowerPoint presentation. We're going to go through this now, summarizes things up nicely. So obviously, existing home sales, seasonally adjusted annual rate, that's what SAR stands for. So you can see that, hey, we had a big dip, with COVID, and that's going to look like a V. So I know that, probably tomorrow or today, we're going to see articles from the housing hype hacks that are going to say, hey, the housing bubble boys or bros are, crying the blues now. Well, no, we're not, because, hey, it's an artificially controlled market. We know that, and it's being stimulated in certain ways. And the distress is not here yet, so if you don't want to consider that. So we're going to see this V. And again, the 6.8 million is extrapolating, October sales over a 12-month period, saying that's where that value would be. So it is kind of misleading, because when you actually take a look at, how many total sales are going to occur for 2020, it's going to be 6 million, maybe less than 6 million. So that's just a little bit of a stat bump there. Comes down to so clearly the median price of existing home sales has been going up for the past, obviously since 2016. So here we are at 313. It looks to be plateauing a little bit right now, but again, people are pushing the envelope, and with low inventory, you're going to see price competition for sure. Existing home sales, median price, percent change year over year. So obviously, it was reasonably working through the past few months prior to COVID. We dropped big time with COVID. And now with respect to July, August, September, and October, we see 9, 11, 14 and change, and 15.5% year over year price increase in the median home price. So that's fairly impressive. Here you go. Existing home sales percent change year over year. So clearly we see that we had negative home sale growth during COVID. And as a result, we're now seeing the fall markets, which typically, now listen, if you go back, go to the left part of the chart there. There's October a year ago, 4.2%. There's November, all right? So they're down 4.2, 3.1% year over year last year. Now we're at 21.4 and 26.6, which really, I think, is just making up for the decrease. Like, look at the May. It's almost to the point where May lost 26.6 and now we're up 26.6% in October. So, what do you say here, guys? I mean, if you take a look at that, it's almost like we've now are seeing the spring, summer, typical housing market occur. A few months later, it was on pause due to the COVID restrictions, shutdowns, and issues. So market conditions, this is what I like to look at. First-time home buyers did jump up a little bit compared to last year. Sales to investors remain the same. Cash sales remain the same. Distressed sales down, 50% of what they were last year. Days on the market down considerably. That's 3 weeks. On average, it's 3 weeks to contract, where it's about 5 weeks. If you think about, just over 5 weeks, I'm taking a 7-day, week essentially. So about a month and a week to contract the year before. So what that means is people are getting out in the field and they're putting stuff under contract as quickly as possible. They don't want to lose it. And if the faster it goes into contract, the less risk for bidding wars and things like that. So interesting to see that's happening. This is where I focus on the distressed sales. So distressed sales are made up of two components: short sales, okay, that are closed short sale transactions, and REOs, which stand for real estate owned, which is bank-owned foreclosures that are put back on the market and sold on the MLS. So realize that there's lots of real estate that goes on that does not hit existing home sales. This is produced by NAR, National Association of Realtors, which basically goes to the MLSs across the country and extrapolates the data and does some summary here. So why do we have such low distressed sales? Well, this is due to the 3-level moratoria that we have in place. So you have the FHA moratorium going on now, right? FHA loans with no evictions or no foreclosure sales or foreclosures being processed. You have the CDC moratoria that's in place, that is out there. And you could have a 3rd level, which could be your own individual state moratorium that's going on. Some states have relaxed their moratorium and are falling back on the CDC guidelines. Others are using all 3. So, but what I keep referring to is the distressed sales, and this is the opportunity. The reason being, nothing is going on distressed sales, which means distressed sales are, I won't say surging, but they're bubbling underground, under the radar, and when they will hit, this will be a little bit of a free-for-all coming forward, okay? So this is where we want to focus on, and that's where the great opportunity is. So when I talk about opportunity, it's stuff that's happening now and will happen in the new year as things kind of open up. All right, so getting back to the NAR stuff here. All right, let's get to the next slide. Basically, existing home sales by region. You can see that the South typically leads every month and with the distribution of homes. Midwest 24%, West 20%, Northeast 13%. Tends to be how it typically breaks down. Doesn't really change a heck of a lot. Housing supply at the national level. So really, we see housing supply going down. The red is the single family supply. Green is the condo and co-op. There's always more condo and co-ops available, and then the blue is the blend of the two, right? National Housing Month supply. So we're again about 2.5 months. There are specific markets. For example, the market I'm in, single family supply, 1.3 months. All right, exceptionally low, and that's driving price point, value, chaos, the whole bit. It's a undue. How can I put it? It's really a unofficial or not official. I'm trying to say, like, it's an unnatural stress in the marketplace. That's what we're experiencing right now. So sales by price point. So what we see is the 0 to 100K level at 5%. That's actually decreasing. The 100K to 250K, which I call affordable housing, 32%. The 250 to 500K at 41%. 500 to 750K, 13%. I think that's increased. The 750 to 1 million at 4%, and the 1 million plus at 5%. That typically is 3 or 4%. So that 1 million segment, the higher end homes, I believe, are increasing a little bit more. Look at the percent in sales change from a year ago by price range. So yes, it is increasing. So we can see that the 0 to 100 on the bottom left of the graph there, that's actually the value, or the number of sales in that segment's decreasing by over 20%. Looks like a little bit of an increase to the 100 to 250. Sales are obviously increasing, 37% over 64%, almost 80%. And look at the 1 million plus. So that price segment basically had a 100% increase in sales from a year ago. So, does that mean that people are cashing out and relocating? Could be. Could it mean that their prices are dropping, or with low interest rates, that segment is much more attractive now, and you have more buying power to buy in that segment? It could be as well too. So we don't know what those reasons are, but suffice to say that you can see that there's greater than 500%. We're seeing significant increases in sales activity, sales volume from the previous year. So very interesting. So again, this is an interesting kind of chart as well too. This is a regional breakdown by sales price. If you go to the first chart, like the first, we'll call it the grouping there, the first chart, and you go to the far right, 1 million. Take a look at region. Region goes down the left. Price point goes down the top. So take a look at the 1 million plus. Well, the Northeast grew. The sales of over 1 million in the Northeast region grew 138%. It grew in the Midwest 142%. It grew in the South 110%. It grew in the West 84%. Why is the West growth a little less? Because they are traditionally higher priced, so there's probably more million plus sales going on there in the first place. So interesting to see how that works out. Sales distribution, the next chart, in that million plus segment, there's more sales in the West for the $1 million sales distribution compared to what's going on across the board. And changes in inventory, obviously, when you take a look at changes in inventory, you can see that the 0 to 100K is losing inventory all across the board. The 100 to 250K, losing inventory across the board. The 250 500K, losing inventory across the board. The 500 to 750K, losing inventory across the board. The 750 to the million K, almost losing inventory across the board, except the Northeast where it grew a bit. And the 1 million plus, we basically have, again, across, 3.9% growth in the Northeast, and everything else is losing inventory. So it's pretty much all market segments are losing inventory. And, it seems like, the only opportunity, only region and segments that are getting an increase in inventory is at the higher end in the Northeast. And that could be for a number of reasons. Could be people leaving, Boston, New York, Long Island, Jersey areas, whatever, where homes tend to be a lot more expensive in those locations. So again, just interesting to see how that works through. What's the point I'm trying to make here? Well, what, like I always say, don't get a false sense of where the housing market's headed. We are all over this bubble. I'm over it. You're over it. Other buyers are over it. It's just like it just keeps going on. And the problem is, because data is so readily available, we keep seeing this play out here. And the changes that we want to change aren't happening. As I said, the market is somewhat being manipulated right now. There's a truth to that. Two housing narratives in play: the K-shaped housing market. So we still see prices going up, which is the going up part of the K. The bottom part of the K, we're not seeing yet because it's not available for us for us to see, because we're not seeing the wave of foreclosures hitting and things like that. So, but changes are happening, starting. So as I say, I'm starting to see stuff in various regions of the country that's starting to open up a bit here, which really is opportunistic if you're looking for that. So what we need to have here is more off-market homes are coming on. More distressed homes will be available. This is called the shadow inventory, so it will start to pick up. Foreclosures are starting to pick up across, like in certain regions of the country, like for example, Florida. I looked at a lot of locations, and stuff is picking up. More and more homes are having their foreclosure sale dates set now, and that provides opportunities on different levels for different market segments and different buyers. And also I've just seen the past couple weeks off-market sales picking up now too. You don't know, based on the eviction moratoriums and things like that, how Mon Pod landlords are being affected and et cetera. So this will all start to play out in the next little while. All right. So what we have to remember, though, is that we will have to compete for all this inventory with the institutional buyers. They're going to be jumping all over these properties here. So the point is we have to get ahead of them. And I think is the biggest takeaways. I know what's going to happen. We see that they're getting ready to deploy. We know what they're buying or what they're going to buy. So it's getting ahead of them, getting to the homeowner, getting to the client first, as opposed to waiting for the stuff to come back in the marketplace, because they're going to be buying all this stuff at auction, and we have to be aware of that and prepare for that. So that's kind of what I talk about. So if you need to contact me for a consultation to find out what I'm talking about, hit me up, just send me your information, and we'll schedule time to talk. I have different methods to acquire property. Listen, the housing market is now controlled, manipulated. If you don't believe that, then start doing a bit of research. But when we have people who are saying we're in a bubble and they're talking about it, that's usually a prelude to, hey, we're going to have problems. So, when certain people say certain things, I think they really are warning signs, and the signs have already been there for quite some time. So it's a matter of how this is going to play out. Listen, the housing market recovery that we had from the last housing crisis was completely controlled and manipulated. So it makes sense. Like they're controlling the bubble and how it's going to burst and how it's going to play out as well too. So the whole point is get in on the know, get the knowledge, figure it out. I can help you do that. So anyway, guys, appreciate the views, likes, and comments. As I said, here's my email address. Reach out to me if you want to talk about anything. Lots of opportunity on the going forward basis. I know we're all frustrated. Hang in there. I hope things are going to change in the next little while. But right now, we sort of see this final push with low interest rates to further fuel the housing bubble that we're in. All right, guys, take care.